you might have more success finding deals that are mom and pop owned, that you can buy at better yields and, have more unrated renovated stuff where, you're not running into as large of problems of less cash flow day one, where, you're probably not going to be hitting double digit cash flow day one, but there is room to renovate and push rents or just organically push rents or manage better. So I think it really depends to where you're looking. Because that's one of the reasons why, when I left Toro, moved down here, it's, the sole reason I'm focused on smaller properties is I just think there's a better chance to find better deals, better yields, better returning properties than in the 100, 150, 200 unit space.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me, as always, is John Cohen. How's it going, brother?
We are doing good. I feel like there's a lot of good things happening. I'm not buying any deals, but just some good things taking place. We figured out we're doing $50,000 monthly distributions on 3 properties that we own. We've been doing them through COVID. We bought 1 property in February of last year, 1 in April of last year. These are 2 acquisitions in 2020, and they are spitting out monthly distributions. And we're raising rents at both the properties. Literally every management call we get on, we raise rents $100, and it goes unaffected. It's market blending, the deal well, and it's just crazy to me. The things that are happening. So it's super exciting. I know we have an awesome guest. I didn't even realize he was going to be on our podcast, and I saw a fund that he's launching. So when I put 2 and 2 together, or a fund that he has open, put 2 and 2 together, I pulled up that email and I said, oh shit, I'm actually looking forward to this one. Not that I don't look forward to all of them, but this one should be pretty cool because it's a space that I suck at. And I think he's gonna, shed some light on some pretty cool things on some, awkward sized mobile homes too. So it's gonna be fun if we go in that direction.
Yeah. Well, it sounds like we will, because I'm not gonna be able to hold you back. And a slight nod to all of our former guests. If you felt like John wasn't enjoying the conversation, you were right. He clearly wasn't. But he's gonna enjoy this one. So I'm happy to have our guests on today. So with that being said, Daniel, thank you so much for coming on, bud.
I'm glad to be here. I just want to set a really low bar. Let's assume you guys are both going to hate this conversation. I'm going to be a super boring guest. And then if I exceed expectations, I'll just be icing on the cake.
Perfect. We'll go back. We'll re-edit it in and just say this guy sucks. I don't even know why we're having him on. And then sky's the limit.
Good.
Perfect.
Good. Well, thanks for having me, guys. This is fun. I'm glad to be talking to you guys, fellow entrepreneurs. Mm-hmm. Always excited to chat. I'll give you the 30-second background on me. I run 3 Pillar Communities. We are a top 50 owner of mobile home parks in the United States. We operate 34 communities in 5 states. We have about 60 employees. We're vertically integrated. We have about 8,000 residents. I started doing this in 2017. Before that, I got a law degree and MBA. I worked in the corporate world, but really my family background is in mobile home parks. My family immigrated to the US with nothing. My grandfather worked as a car mechanic, saved money fixing cars. He bought a mobile home park about 30 years ago. So I grew up around it. My heart's in the space. I love it. And I'm glad to be building a company, doing something meaningful in the world, and excited to chat with you guys.
So before I let John dive into his million questions, because I'm sure he has them, is it weird for you to see how the mobile home park has changed perception-wise from, 30 years ago to today? Because I feel like, it was, the quote unquote perception was, more like trailer park trash. And now it's kind of edging towards, manufactured homes. And I'm curious if you've seen the same thing.
Yeah. So I'd say mobile home parks historically were the most stigmatized form of housing, right? You say a trailer park, the connotations are meth, pit bulls, drug busts, you name it, right? Because that's what you see in TV. It's what you see in the media. And that is not what our parks are, right? As you said, the world has changed and there's massive need for affordable housing and not enough supply. So a lot of folks in our parks are working families, right? Not even necessarily blue collar. Some of us what I would call kind of gray collar and middle class folks working in our parks, living in our parks. So yeah, it's been exciting to watch that kind of progression of acceptance. But there's still a lot of work to do, right? Because there's still a lot of slumlords out there. There's still a lot of people not managing their parks right, getting in the newspapers for all the wrong reasons. And so we still fight a lot of stigma, a lot of stereotypes, and kind of I'd say the burden is always on us to prove why this is a legit form of housing that, you know, provides an important service to the community.
So I love that, because in 2017, I bought my first mobile home park. I remember.
Tell me more. Tell me about the deal. Where was it? I want to know.
It was small. I bought it with a buddy of mine. He lives in Myrtle Beach, South Carolina, and we owned a 240 unit in Greenville, South Carolina. So it was a 7-lot park in Greenville, South Carolina. We got it through a direct mail. My buddy drove, met the owner, 60-plus-year-old guy. He's owned the park forever. He had 3 open heart surgeries, no family, and he basically just said, this thing's going to kill me because it's going to take up so much of my time and I just can't do it. He was like 475 pounds, just not in shape, and he couldn't do it anymore. So he seller financed us. We bought it. We put very little down. And 4 years later, the park's paid itself off ridiculously. And we actually just
several times over.
Yeah. Oh, it was... Yeah. My buddy will send me a distribution on it because it's just me and him, right? It's 50-50. We both put up the down payment, and, you know, he'll send me a check and he'll send me a text. He's like, you're going to get a surprise in the mail. $7,000 distribution. And I'm like, what's this from? He's like, oh, the mobile home park. And then like 3 months later, $4,000 distribution. And I'm like, this thing's insane. And we just listed it. You know, we bought the park. I think we bought the park for, it was like $92,000, and it's on the market now. Actually, it's going to market shortly at like 175. So, I mean, it's owed us virtually nothing at the end of the day. And, you know, we've grown that. You know, we bought a 40-lot park, a 70-lot park. We have our multifamily stuff. And when I first started doing it in 2017, I remember it was either 2018 or 2019. It was 2018 at NMHC. National, Multi-Housing Council, that conference is the biggest multifamily conference of the year. All I was talking about was mobile home parks in 2018. Literally, all of our meetings with our equity, that's all I spoke about. And everyone's like, yeah, it makes sense, because we bought Class C and B multifamily, and it was affordable, affordability. That space has just disappeared completely. And the mobile home space, or the manufactured housing space.
You mean disappeared because of competition, that it's overbought?
Disappeared from the standpoint of, rent growth has just been astronomical, and it's very difficult to find an apartment community where you can deliver affordability. Our Class C apartments are $1,000, $900. And that, to me, is not a lot rent of $350, right? Where someone owns their house, or whether you sell a trailer. Like we just sold a double wide home for like $45,000 in Walterboro. Guy's gonna be paying $750 a month, $350 lot rent, $300 on top of that, or $400 on top of that. And he's a blue collar, gray collar is probably a better example of that. Him and his wife, one works as as a waitress, the other works, regular blue collar type job. And they were so excited to the pride of ownership in a community that we bought that was a disaster, that we rebranded, cleaned it up, landscaped it. And even the tenants there were like, wow, like you've just enlightened us on what this place really could look like, because it was owned for 30 plus years.
Totally.
So that it's so rewarding to provide a double wide 3-bedroom trailer to somebody that in my 3-bedroom apartment, we're paying $1,500 and they don't have anything, right? Yeah. And there's a whole other argument on buying and renting, and that's not the product that we're delivering. But this space, I have not executed nearly where I thought. I thought I would be a top 50 owner from 2018 to now. We only bought maybe about 200 lots or so, but it's a space that I love. I mean, I think it's the last bit of affordable housing, and affordable housing is disappearing because it's just very expensive to build and all of that stuff. So I think everything you said, I echo, and I just think that space is so attractive, and you've seen it from an angle that I couldn't even imagine. So seeing the stigma change, I went into it. I remember in 2017, I was touring a mobile home park. I looked at my buddy who we bought the park with, and I said, if you would have told me at 27 years old at the time, if I'd be standing in a mobile home park in Texas, I would have thought I made some bad decisions in my life. So even me stepping into this in 2017, that's the appearance that it had. We've driven parks, and one of the parks we own in upstate New York, if I dropped you there, you would think it was a purpose-built single-family house development because they are gorgeous, all have attached garages, gorgeous properties, a gorgeous property. So it's not what people think, but that's the stigma it has. And from when your grandfather bought it and you've seen it now, and to manage the parks you do, I'm sure you've seen every single component of that throughout the last 5 years.
John, this is great. So tell me, you're bullish on mobile home parks. You own several in different states, right? Sounds like from the Northeast all the way to the Southeast and all the way, you've looked at deals all the way over to Texas. Why haven't you bought more? Why have you stopped at 200 lots?
So the God's honest truth is, it seems like when we start going down the rabbit hole and we have a ton of deals, a multifamily deal will come by that I couldn't say no to. So maybe our bandwidth was spread a little thin. The other reason is after, when we first started really diving in head first, I wanted to buy stuff in New York, but then the rent stabilization laws and the tenant landlord laws, the wheels came off the bus. So we basically said, okay, no more buying stuff in New York. We continued to buy and look for properties out of state, but we never really dove in the way we should. Now we're spending about $10,000 a month, cold calling, direct mailing, and trying to buy more parks. But we've gotten the approach direct to owner, and we've seen the deals take a lot longer to buy because putting the information together, there's no rent rolls, they don't have financials. We spoke to a guy the other day on a 100-lot park in Tennessee, great location just outside of Knoxville. And we asked him, you're paying $80,000 for 2 full-time employees. He's like, well, they work for me on my 4 other companies. I'm like, okay, well, what do they do day to day at the park? I don't know. Yeah. I'm like, well, how am I supposed to put the right person in there or figure out what it's going to cost me? Because based on your financials that we've put together, your park is worthless. And I know it's not worthless. So it's the deal cycle where you get a deal, a multifamily deal, whether there's a broker or not, you typically have a lot easier time putting together the financials and the rent roll, or a broker says, hey, here's everything. It's vested. A mobile home, it could take you 4 or 5 months to get the real rent roll put together. Because, Mrs. Jones is mowing the lawn on, Tuesdays and she doesn't pay $20 for rent, or they have all these side agreements. Oh, I only pay once a quarter all my rent, right? You hear crazy stories, and we're transacting with owners directly. So the deal cycle has taken a very long time. Now we do have 3 or 4 right now that we're close to buying, which is going to be great, which will definitely, put some, give them something to do, right? Raising money and operating them. Yeah. But it's just been for other things have come across my desk that I've been able to execute on quicker and more efficiently than the mobile homes. That's the biggest struggle for us, is really getting that groove of consistency and that flow, because you're working with an owner more often than not that has owned it for 30 years, 20 years, and they just don't really care.
Okay, let me ask you something else. So you are clearly both entrepreneurial guys, hustling, going direct to owner, doing it the hard way, and you're reaping the results. So I don't know a ton of guys who are doing what you're doing and do both mobile home parks and Class B and Class C multifamily. Most of the people I know specialize in one or the other. You guys are doing both. So tell me, from my perspective as a mobile home park guy, I am, Class B and C multifamily would be a natural extension, but I'm always hesitant because I'm a snob, right? I'm spoiled by mobile home parks. So my tenants own their own homes. They always pay rent. I hardly have any vacancy. I hardly have any delinquency. They've got skin in the game because they're homeowners, and it's very consistent cash flow. So for me to go buy a Class C apartment building is scary. I'm scared. I haven't done it. So you've done both. Tell me, what are the pros and cons? Should I be buying Class C multifamily?
Yeah, 12 months ago, it's the market now. We've put, so I joke around, we're 95% multifamily, 5% mobile home, maybe 90-10. The last 8 months, I'm 70% mobile home, 30% multifamily. And the reason is that we've I did a complete dive the other day, and I look at every deal that I've transacted on, the ones that were ridiculously successful and the ones that were good. Taking market timing out of it, just, if you bought anything over the last 8 years, you could have messed it up pretty good and you probably came out all right. But we looked at deals. The deals that we did really well were, I'll take the class C and B to the next level. We've bought, 130 unit vacant deal in Columbus, Ohio. Not a single person living there. We got renovated the entire thing, rebuilt the entire building, leased it up. Phenomenal deal. We bought affordable, $20,000, $30,000, $40,000 a door deals. We fixed what was broken, major deferred maintenance, coming in and fixing those problems. And we never had to drive rents to achieve our success. It was let's fix what's broken. When we bought a 1999 construction, 1990 construction 240 unit deal in Greenville, deal was, I still say to this day, I would live in that apartment. It was one of the nicest properties we bought. The rent growth was never, we had to be perfect to execute the deal. And next thing you know, a lot of things started going wrong. So we weren't perfect. But the mobile home space, to me, when I looked at it, I said, those class B and C apartments are harder to find today because I feel like the market has been so picked over in the last 8 years. Deals have traded 2 or 3 times. When I first started buying, we were buying from owners that owned for 10 years, 20 years. That's where the mobile home side to me is like, okay, I don't have to go in here and raise rents. I have to go in here and collect rents, or I have to go in here and fix problems and landscape it and clean it up. The rent growth will come because every other park is 400. We're buying it and it's 150. So they can't go anywhere. The mobile home, the multifamily side now has been a little bit more challenging where you buy it and you have to factor in rent growth. And I have to renovate. Should I do stainless steel or should I do black appliances? Well, everyone else is doing stainless steel and their rents are $20 higher. Do I want to achieve that or not? So it is scarier for me to go and buy that today. Would I be scared if you were going to look at it? Not necessarily. You know what you have in mobile home parks. The only difference would be, do I want some diversification in the housing space, right? That's where I can see someone saying, I'm going to go buy a B and C class apartment because I just want a little bit more, diversification than just strictly mobile homes. But from the standpoint of both of them, they both offer benefits, but huge benefits. But I've underwritten more mobile home deals in the last 12 months than I have multifamily deals because the multifamily deals come to me, I throw a ridiculously low cap rate on it, and I'm still 20% off what they want. Mobile home deals come to me, I can throw a low cap rate at it because the market has changed significantly, but you're still at predictable cash flow. And today, more than ever, I would much rather cash flow than 12 to 18 months of heavy renovation to achieve cash flow in the future. I want to buy something today that gives me money today because cash flow is absolutely critical.
So has it always been your perspective? You're saying right now with disruption in the economy and rising lumber prices and rising construction costs, you don't want to be doing heavy rehab jobs?
Yeah, so I would say every deal we bought prior to maybe the last year, we told investors 24 months, no cash flow. We're going to go in, we're going to spend $7,000 to $15,000 a door renovating everything and fixing roofs and plumbing. And we're going to drop the occupancy from 90 to 70. And we're going to renovate 30% of the units in year one. Don't expect cash flow.
Yeah.
But part of my hesitation in today's world, especially what just happened, our tenants paid. We really didn't have much problems through COVID, but that hit. And I said, if everyone stops paying, I got some problems. Pride of ownership and not being able to move your home, you're probably more likely to pay, right? Just inevitably, you don't want to lose that. Yeah. So I think that level of buying something, multifamily deals are selling at 4 caps. So if you don't have debt that is 3%, you're not going to cash flow day one. It's why I don't buy stuff in New York, because when I was a broker in New York, you'd sell deals at 2 and 3 and 4 caps, and debt wasn't 4, 5, 3, 4, 5%. You were at a par or a negative on the interest rate. Mobile home parks, if you could buy it at a 6 cap or a 5 cap or a 8 cap, you can get debt at 3, 4, 5%. So you have an automatic spread when you take over, or you could put seller financing on it. There's so many ways to pull the levers to cash flow today that is a lot harder in multifamily to cash flow without financially engineering it.
Yeah.
So the only thing I'll add to it is, John, you gotta, you're talking about the 150 plus unit space in more primary and secondary markets. Like Daniel, I know you guys do a lot of smaller properties and probably in more tertiary areas. You might have more success finding deals that are mom and pop owned, that you can buy at better yields and, have more unrated renovated stuff where, you're not running into as large of problems of less cash flow day one, where, you're probably not going to be hitting double digit cash flow day one, but there is room to renovate and push rents or just organically push rents or manage better. So I think it really depends to where you're looking. Because I mean, that's one of the reasons why, when I left Toro, moved down here, the sole reason I'm focused on smaller properties is I just think there's a better chance to find better deals, better yields, better returning properties than in the 100, 150, 200 unit space.
Sure.
Another thing for you too is, you managing 40 lots versus 40 apartments, that's way more dollars coming in for, management and all that different stuff too. So, yes, it's going to be more intensive from, turning over units, you're going to have to do the repairs. You're going to have more vacancy from bad debt, physical vacancy, concessions, things of that nature. But in theory, those same 40 units or lots is more actual dollars coming in.
Yep.
Yeah. So Chris, how small do you go?
So I have a 16 and a 24 unit right now.
Nice.
Yeah.
So you're not looking for like duplexes and triplexes. That's too small. But
no, I mean, I've thought about like buying those just to like flip them, like get in, renovate, and then sell them off. But no, that's just too small for me. So ideally it would be 10 to 80 units pending some market.
So I think Chris brings up a good point, right? I'm speaking in the 150, 200 unit plus space. And when we went to buy mobile homes, listen, I would love to buy a 220 lot park in, a major metro outside of a million person MSA. When we started looking at mobile homes, we went inefficient out of the box. We looked for 40 and 70 and 20. We looked for that stuff because we knew the owner of that would most likely be the owner that fits the profile that we like to buy from, because we know we can bring the professionalism and fix things. So Chris, excellent point. I think there's still a great opportunity in 20 to 80 unit multifamily deals. So if you're going to step into that, buying from a longer term landlord or even a newer landlord, you probably have efficiencies. Even coming from the mobile home world, stepping into that space, you would absolutely achieve it and probably be very successful at it, because you're going to bring a level of professionalism to something that may or may not be being run 100% proper. And that's where we see the most value in real estate. It's not in, I got to lease up 30% of this apartment. That's great. But if you can bring efficiency to inefficiency, you typically win. And that's what I love. And I tell people all the time trying to get into the multifamily space, go buy the inefficient stuff and get your hands dirty, because you'll be able to do it better. Now, and we don't even do that. We have third-party management or almost quasi-in-house management on our multifamily stuff. Our mobile homes, we manage ourselves. And if you can get yourself into that place, you would be extremely successful. Anyone would be when you're buying that smaller stuff, because there's less competition on it. And less competition, right? There's competition no matter what you buy, but you're not competing with all these groups out there that are on Facebook and Instagram and all these syndicators and massive companies coming together, because four people can't come together to buy a 20 unit syndicated. It's never going to generate the money that's needed for everyone to eat. They have to come together and buy a 200 unit. So inevitably, if you're a one-off investor, or you have 4 or 5 investors, or you have, even if you raise money from 20 friends, but if you're the only operator, you can buy that small stuff and do very, very well. And I think you very successfully. So
how inefficient is it? Chris, give me a sense of return profile on a 20 unit deal. Are you buying 10 caps? Are you projecting 40% IRRs? It's not that.
I mean, it really depends, for me. So like the 2 deals I bought had 2 very different inefficiencies. So the first one I bought, the expense side was very inefficient because it was a larger management group that was managing smaller deals. So perfect example was they were paying $750 a month for landscaping. I was able to get it down to $360 a month.
Yeah.
You know, their pool cost was $500 a month. I inherited it, but it's something I'm pretty confident I can get down a couple $100 a month. You know, so it's little things like that I saw that could be done better.
Because they were just corporate and you can be scrappy.
Yeah, and it was, you know, they were managing, 12 smaller properties, so it's a little bit tougher. You know, also when I came in, what tenants were telling me, who knows how true it is, was, hey, you've been, way more involved in fixing things that they haven't fixed in a long time, which I think goes a long way and has been helpful in some of the renewal increases that we've gotten. On the flip side, the other deal I bought was very well managed. It was 6 quads. They'd owned it for 35 years. The expense side probably as efficient as you can get. The income side, though, they were $300 below market. We turned a unit and raised it from 700 to 1,000. So inefficiencies on basically both sides of the coins. Now, is that every single deal I look at? No. I mean, I've probably looked at, 40, 50 deals before I bought, probably looked at 20 to 30 before I bought the first one and 30-ish, 40-ish before I bought the second one. So it's not every deal, but that is way more likely, in my opinion, to occur than a 200 unit property because, any decent property management company can find all that stuff out, right? And that for me is something that I feel is true. I haven't been able to prove it out yet because I'm 6 months into it. But as an owner operator, property management companies just have to do a decent job, right? We provide a service that has customers, those customers are tenants. And because there's such an arbitrage of supply and demand in our favor, you can get away with a lot and still be very occupied, right? You don't have to be the best customer service experience for tenants to keep your property full. You can just get by doing an okay job. And honestly, you can get by doing a pretty shitty job, right? Which is why there's slumlords in general, right? Yeah. If property owners were companies competing with like Amazon, if you were a slumlord, you wouldn't have a company anymore. You'd be out of business. But because it's such a need for people and because there's such a supply and demand problem and because, there is no affordable housing, people just put up with a lot of shit because they need a place to live. Yeah. So for me, it's like, okay, if you can build out that owner operator platform, which you've been doing in the mobile home park space, I think you can easily transition into multifamily and find tons of inefficiencies with, in properties, not only in the smaller to mid-sized space, but probably also in the larger space too.
Interesting.
So, I think it's really valued.
I didn't think this is where the conversation would go. They were debating the merits of multifamily versus mobile home parks. But now that we're talking about it, I'm thinking about it. Like if we were to dabble in multifamily, the logical place for us would be strong tertiary markets where we already own mobile home parks. We already have a base of operations. We're already visiting those towns. We already know that there's a ton of demand in like Moscow, Idaho, or Delano, California. These little markets no one's ever heard of. That actually have strong job drivers, strong housing demand. And if I could go buy a 30 unit or a 40 unit apartment building in one of those markets, I mean, there's just so much more of that inventory than there is mobile home parks, right? There's probably 20 or 30 times more apartment buildings in the US than there are mobile home parks.
So that mindset right there, we took the reverse approach. We said, okay, we own in Greenville, South Carolina, very good secondary market.
Killer market. Greenville's one of the top markets in the country.
We said, what secondary and tertiary areas around there can we buy mobile homes in? Because we have a multifamily property set up with the property management. But if we're already there doing what we're supposed to do, touring our properties, why can't we manage our own smaller deals in inefficient areas? That's the approach we took to buy mobile homes. Now, if you take that same approach and just said, let's go buy multifamily where we own stuff, you already have a team set up. So, and you're right, there's way more multifamily inventory than mobile home inventory. And when you start getting, yes, I'm sure there's a lot of 10 lot parks out there. If it's not down the block from one of your parks, you probably never even look at it. But how many 10 to 50 unit apartment complexes or 20 to 60 unit apartment complexes are near those markets? That's, and I mean, you're buying in some strong, like Denver, Fort Collins, just from that email, I have a dream of living in Montana. I absolutely love Montana, right? So like,
come buy a home in my new development, John. I got one with your name on it.
So, you're buying in some formidable markets as well. But if you can buy those very difficult deals, you will absolutely find good deals in the multifamily space. No doubt about it.
Yeah. The other thing too, in those smaller markets, you'll probably find, where John was saying 4 caps, you're going to find stuff higher than that. You're not going to,
absolutely.
you're not going to you shouldn't buy 4 cap deals there, because you could buy a 200 unit 4 cap in, Raleigh, North Carolina. And that's a way better risk reward standpoint. I think the one thing too for you that, might be more interesting is if you are looking for these deals with long-term cash flow, when you improve properties with that lower cap rate, you're increasing the value a lot more, which could help you, like refinance properties, hold them long-term, and kind of build value quicker, build a balance sheet and net worth quicker. So it may be like, maybe not what you like about the mobile home space, but maybe it's a good complement to a lot of the stuff you do as well. I don't know.
Yeah, it's interesting. John was bringing up the diversification point. To me, I don't see a real need to diversify into apartments just for the sake of diversification, because you're dealing with a similar tenant base, similar demand drivers in similar markets. So I don't see a strong diversification argument. I think the argument for me would be A, volume, right? There's just so much more apartment inventory out there. And B, Chris, to your point, the rate of value creation, right? You can get a faster value pop, I think, on a value-added multifamily deal and build the balance sheet, build the net worth that way.
I want to run by you. So I've been saying this for since I basically moved down to Jacksonville. A bunch of people have asked me, because I know other mobile home operators, like, are you going to start looking for it? And I've said, I'm not going to spend a single second on it. And the reason I'm not is because when I've been looking at, when I moved down here, one of the things as I was making my decision was, all right, how many smaller apartment buildings are there actually, right? So I pulled the list from the county, and there's thousands, right? A majority of them are less than 10 units, but even, 10 to 80 unit stuff, there's several hundred of them. So I was like, okay, that's a pretty good supply. When I start looking at how many mobile home park communities there are just in the country, I haven't pulled the list for my area, but it's like you were saying, it's just so much fewer. When I kind of broke it down, it's like 40 or 50,000 parks across the country, right? Something like that.
Yeah, that's right. That's right.
Say, okay, half the country, I started, dividing the country, right? I said half, okay, we're at, call it 25 maybe. Then you take another quarter, so I'm in Florida in the Southeast region, now you're 12,000. Then you take one state out of 12. Now you're down to 1,000. Then you take one city out of the whole state, and you're down to how many? Then you've got ones that are too big for institutional, too small in bad areas. And I'm like, my supply of possible things I could even buy is so small. And then I said, now you've got all this interest coming into the space from these other areas that's chasing cap rates. I'm like, by the time I got to anywhere that would be somewhat scalable, I feel like I'm going to be too late, because at least with apartments, right, you have new supply coming in, right? So at least as more people come into the space or more capital comes in theory, you have new supply coming in to help balance it out. Mobile home parks, you're as soon as you run up, right, everybody used to say 80% mom and pop owned. I feel like I've been hearing that for 3-4 years. So that can't be true anymore, right?
Chris,
so what are you at, 70, 60%? Well, it's just going to keep getting worse and worse and worse. And I just feel like I'm fighting this uphill battle with limited inventory. So I've kind of gone the reverse and said, I'm not even going to spend a single second thinking about it. In your opinion, do you think I'm, right to think that way, wrong to think that way? As I say that, what are your thoughts on it?
God bless you for telling the truth. Seriously, the last minute should be the highlight of this podcast. There is so much bull crap on the internet saying you can go find mobile home parks for cheap, and you're going to go direct to owner and cold call, and you're going to buy them at 8 caps. And there is way too much money in this space chasing not enough product, right? And prices are getting bid up and bid up and bid up. And Chris, I think you are a very wise man to think analytically about how much inventory is available within a given market, and how do you want to scale your business, and say, I'm not even going to chase the mobile park dream, and I'm going to focus on this other asset class where there's so much more inventory and so much more ability to make deals. So I think you're really smart. In my space, all I do is mobile home parks. It's tough. Yeah, man, it is tough. Even when almost all my deals are off market, right? I've bought 22 or 23 parks in the past couple of years. I'm in contract on 8 more. We've deployed around $120 million so far to buy parks. Like, all I do is mobile home parks. It's almost all off market. Even then, we're not stealing these things. They're expensive, even when we're buying them off market. Typically off market, we're still competing against some other group off market. Every owner gets, 5 calls a week from brokers and wholesalers and guys who went to Mobile Home University. So it's super tough out there. I'm committed to this space because I believe in the long-term trends. Like John was saying, space rents are low, right? They're typically a fraction of multifamily rents. So you've got built-in affordability, and I believe in that. Mm-hmm. And I believe in affordable home ownership, that our tenants really enjoy owning their own home. So I believe in the space. I built a platform in the space. We're good at operating in the space. But Chris, I think everything you're saying is true. And I think it's kind of a counterpoint between what you said and what John said. Where Chris, you're like, I'm not going to chase parks. It's too hard. And John, you're saying you're spending $10,000 a month to go, cold call mailers, try and find those mom and pop owners. So I guess like those mom and pop owners are still out there and you can find them, but it's a lot of work, right? And you're competing and you're really working hard to earn those deals.
Mm-hmm. Yep. So I think what you just said is so key. You're right? When I first started, 80%, that mom and pop, the reason why I don't mind the spend to find the deals, it's a dwindling supply. And affordability in this country is virtually non-existent. So from an investment perspective, my multifamily platform, I'm good at it. I know I'm good at it. But if I can supplement that with a dwindling supply and a need for affordability, that's like having the last bottle of water when everybody wants it. So because I'm so bullish on the space, the spend to me is fine. Because typically you buy 1 or 2 deals, the value you create relatively quickly over time offsets that spend. But you're right. I mean, we're battling on deals that make no sense at all, but there's 4 offers on the table, or they have 27 people contacting them. But if you can bond and network and understand the individual selling it, professional, mom and pop or not, and you can offer a solution to any problem they have, that's where we typically push through and win, and that's one of the challenges we've had, just coming from the apartment space. And when you're right, the velocity, I mean, think about it, right? We've owned 4,500 apartments and we own 200 mobile home lots. So if you want velocity and you have capital to do deals, you got to get out of the mobile home space, because you just can't do that many unless you can pay for it because you're very, very bullish on it and you're going to hold it forever. But the velocity and the turnover, there's so many other products that you can buy, whether it's single family, there's so many more of those than alternatives. So I think it's an extremely smart point to make, right? That's why we started buying in New York before the rent laws changed, because New York's a shitty place to be, right? People are moving out of New York, but there's no such thing as affordability, and there's a ton of mobile home parks. But when basically our governor decided that nobody has to pay their rent and you can't raise rents anymore, it made it very difficult to buy stuff. So, it's an awesome conversation because each piece, fits very nicely in the grand scheme of things. And any one of the listeners is probably going to, love the perspective. But the way Chris broke it down, I happen to agree. If you're an individual looking to scale and you start breaking it down, you can't pick a very small supply because you're not going to transact. And at the end of the day, if you don't transact, you can't be an investor and you can't make money. So you need to find something where there is velocity in transacting. And most people don't do that. Most people get an ad, they read something, they get super excited about whatever they're doing, but they don't look at the supply and demand and the turnover. And if nothing's selling and there's not many of those properties, you're not going to buy anything.
Yeah, exactly. And that's, by the way, I think we're probably aligned in this, that I always tell people, you want to be a real estate investor, you got to do deals, right? That's what you just said. You want to be a real estate investor, you got to do deals. You got to transact. Otherwise, you were just a dude sitting at your computer, or a gal sitting at your computer, reading Bigger Pockets, or perving or lurking on these Facebook groups or these LinkedIn groups. And it's like, you want to be an investor? You want to change your life? You want to do something meaningful in the world, help some tenants and build long-term wealth? You got to do deals. So John, I'm totally with you on that.
So I got a question for you. I know this is your first fund, according to the email I think I got about 2 weeks ago. That's right. What was the change from either the one-off structures or what made you decide to go into this route?
Yeah. So the answer is we've grown a ton. We have great deal flow. We were happy syndicating deal by deal, which is what we've done until now. But all of a sudden we woke up 3 months ago and we've got 8 great deals in contract, right? That's kind of like, thank God we're in a good spot. We've built the momentum, we've built the velocity, we've built the brand. And so we're getting a ton of inbound deal flow. And with 8 deals in contract, it doesn't make sense to go syndicate 8 deals one by one in parallel. So we said, let's do them in a fund. It's our first fund. We might still go back and do individual syndication in the future. I'm not opposed to that model. I think it's a good model. It was the right way for us to start. But you get to a certain, everyone said, at some point you're gonna get to a point where it makes sense to raise a fund. And I was like, no, I like syndicating. And I woke up and I'm at that point, turns out.
So I think that's extremely, because we get the question all the time, why haven't you done a fund? Or when are you going to do a fund? When are you launching your fund? It's a lot harder to say, give me $1 million, I'm going to buy deals, or put $1 million in, I have 8 deals or 4 deals, right? So that's the answer I typically give. For me to go raise $20 million to go buy deals, I can probably do it. But I would much rather say, these are the 5, I'm buying them, and we're going to operate them collectively.
Yeah.
As opposed to, we're going to go find them, because it's a lot harder to do that than it is to say, here are my deals in my markets that I own, I operate, I'm familiar, I'm set up. It's a lot easier. So, that's the honesty behind it. Most people, it's that point of time. But it's got to be a lot easier. Some of them might close, some of them may, but at least you have an outline of deals that are definitely closing, and it'll give people, okay, we're going to go after these and we know what we're doing. Exactly.
It's been interesting. My investors always liked seeing the one-off syndications, so they can, underwrite the deal themselves. Do I believe in this location or not, right? And when they're investing in a fund, they don't have that as much, but it's ease, man. It's diversification. They get access to 8 deals instead of 1. They write 1 check, it's 1 K1, and they're getting broad exposure across, I think this fund is going to be in 5 different states. So geographic diversification, as well as diversification across the risk spectrum. We're doing stabilized deals, value add. We're doing 1 brand new park development deal, all in the fund. So it's a cool package for investors. I believe in it. I'm putting a big chunk of my own net worth into the fund. My family's investing, so I'm psyched about it.
Yeah, no, it's exciting. When I saw it, I literally had your email started because, from my standpoint, trying to find deals, I'm like, see, it's being done. Like, there's no reason why we can't. Like, everyone that tells me, like, oh, the deals suck, nothing's happening. I'm like, guys, here are 8 deals in one-off random locations for the general perspective, right?
Yeah.
Look at it. Yeah. Not, like I said, they're super. I mean, Ogden, Utah is one of the best markets in the country, right? I mean, Utah as a market is one of the best markets in the country. Someone I'm trying to get on our podcast, Jeff Grasso, he just moved to Utah to scale his business in Utah. So, you tell someone Ogden, Utah, they look at you like, what are you doing there? But there is these deals are being done, and the people that are cold calling for me and my mailers, I've sent them this email 4 times to say, guys, look, don't tell me you can't find deals. These are 220 lots, 47 lots. They're big ones. There's awkward ones. I'm not saying I want 15 cap deals. I'm in the realistic realm of what these things sell for, and I hate when people tell me they can't do things, because that just means you're not trying hard enough, because it's out there. You just got to go find it. So when I saw your name, I was like, wait a second, why have I seen that recently? So I just thought it was pretty cool. I give you all the credit in the world, because I think, obviously you've built a great business in a space that I love.
Thank you. Sorry, Chris, I know you've got a point you want to make. Can I ask John real quick, one follow-up question here?
Yeah.
So, John, you sound like someone who doesn't want to take no for an answer. Right?
That's about right.
Yeah. You believe anything's possible. Your guy's you see a brick wall, you're gonna plow right through it. And so you're frustrated. You've got guys cold calling, and they're saying, I can't find it. And you're like, F you. If it was me cold calling, I'd find it. If I was talking to those owners, I'd make the deal. Like, how is it that for you guys are, falling on yourselves, you're not finding the deals? How does that mindset help you and hurt you as an entrepreneur?
So I'll tell you the best. So I just started putting my own list together to show up the cold callers to build a pipeline. So I'm going to do it myself once again, because I've done it in the past. It helps, because if there's a will, there's a way, right? You're going to fail so many more times than you're going to succeed to be successful. hence the baseball patents, right? You know, I know Chris and I just spoke about this. In baseball, you fail all the time, way more than half, and you're one of the best players in baseball. So I think that's where it helps, right? Realizing that no is one step closer to a yes. Where it hurts is you probably bang your head a lot more than other people that are willing to, you know, just go buy a broker deal, or, you know, they don't want the perfect situation. So where my biggest problem is I want perfect. Coming from someone that is so far from perfect that it's scary. So like, I want people to succeed, and sometimes it hurts knowing that, you know, maybe they're just saying the wrong things, and I've just been in the situation more, so it's more natural to me. And that's where it hurts, is that you always want people to do the best they can. I don't care if you fail. I just want to see the results that you're doing everything you can. And I don't think we're seeing that from some people, where it's a lot easier to say the market's changed and I can't buy the deal. And I'm like, well, what do you mean by that? Just because the market changed doesn't mean you can't buy it. It just means something else has to give. And that's probably the two easiest ways I could point to where it's super helpful and where it's super, you know, harmful.
Yeah.
Awesome. Dan, I was going to ask, with you going to the fund model, you kind of touched on it, but how much different, or if it was harder, how much harder was it raising money for the fund structure versus, you know, the one-off syndications? Because like John said, I think everybody thinks about it or dreams about it, but, you know, very few people actually change to that route. So I'm curious what it's been like for you.
Well, I appreciate the question. It's actually been fun, and I really like raising for the fund because it's a big raise for us. I mean, you know, we're raising $25 million. In real estate standard, that's, you know, a rounding error, but for us, it's big money. And normally we've been raising deal by deal, you know, maybe we need $3 million in equity for a deal, or $4 million. The problem is it sells out super quick. We built a great investor network, we fill it really fast, and then people end up disappointed. Why didn't I get in? And I haven't been able to build relationships with new investors because I'm busy just trying to give equity to my existing investors. We're all fighting over allocation, right? So it's actually been really nice to have a nice big raise and stretch it out over, you know, a 2-month period, have a lot of conversations, build new relationships. People are telling their friends, and it's really helping us build the brand. So I've enjoyed it. You know, it kind of feels like a mountain to climb. I'm not at 25 million yet. I'm at like 21 million. Still hoping to raise a few more $1 million on this thing. But it's been cool. It's been really cool. And I think there are some investors, you know, kind of one tier up from the individual high net worth guys, say once you get into family office or like RIA world, who prefer funds rather than one-off syndications. Easier for them to deal with, right? They're not trying to underwrite a specific mobile home park deal, which they don't know how to do. It's like trusting us as a sponsor, trusting the package. So it actually opens up a different set of conversations.
Interesting. I was going to ask too, just to follow up to that, you know, like you said, when you do syndications, a lot of investors claim, and I'm going to use the word claim, that they like to, you know, underwrite the location, underwrite the deal, understand the mechanics behind the deal. I've found 90% of them have no idea how to do it, at least to a degree that makes sense. But I know they like the idea of doing it themselves. Have you found that with that removed, that it's still like, is it still the same investors investing in the deals, or is it a totally different subset? Because for me, like, I see everybody like, oh, I like this market, but they never, or I like this deal. They never really have good reasonings behind it. You know, you have the investors that are trying to become active GPs, which understand a little bit better. But from my experience, and, you know, if somebody's an LP listening, like, look, you know, take it on the chin a little bit. You know, they're just, you know, they're doing other things. They don't have the time to really underwrite it, but they like the idea of it. Is it the same investors investing in the fund, or is it different and people really have a hard time getting over that barrier?
Chris, man, I love that question. I've had the exact same experience where, you know, I'll have a deal in Boise, Idaho, let's say. And an investor say, bad example, Portland. I had a deal in Portland. I had investors invest, they live in Brooklyn. And they were stoked about my Portland deal because, hey, I went to Portland on vacation last summer. Great beer in Portland and great donuts. Right? I had the bacon donuts. Portland's awesome. I'm sold on Portland, right? And like, so which is just to say it's about an emotional connection. Most people invest based on emotional connections, right? And then some people invest based on very analytical criteria, right? Just depends on how their brain works and what seat they're sitting in. So that's been my experience too. Like you said, people don't always invest based on a rational reason. I think when it really comes down to it, my investors are trusting me as the sponsor to make smart mobile home park investment decisions. Like I've got one of my best investors is a highly successful real estate developer based in Miami. The dude builds, high-rise 30-story towers, right? He's made millions of dollars doing like high-rise development in Miami. And he invests, substantial amounts of money in my parks. And he says, Daniel, I don't read the offering memorandum. Like, I don't know how to underwrite a mobile home park deal. You're the expert. I'm trusting your expertise. You made me money on past deals. So you're telling me it's good. You're putting your money in. I'm writing a check. And I think that's 95% of my investors. And there are a few who really want to get into the details. And that's their prerogative. It's their hard-earned money. They should ask whatever questions they want to ask.
Mm-hmm. Yeah, I love it. I think it's really what it should be. And I think it would just be curious for me to eventually do a fund to see if it kind of removes that like mirage for investors of like, look, at the end of the day, you are just investing in the sponsor and trusting them because like, I see like 80% of, books that people put out there, investment summaries, you have the profit and loss statement, the pro forma, whatever. Nobody ever includes the T12. So you have like no idea how it compares to what it was actually even doing. And then it's like, nobody asks like, how do I know this is real? Nobody asked that. Like, if that's really what you were concerned about, right? Where John was saying, nobody's asking the question. Nobody's asking John why he has $80,000 in a pro forma on payroll. And is this person, really doing what they're saying they're going to do? And are they really going to do it? Right. But that's the questions we ask when we're buying a deal, which are the important questions. So it's like, for me, when you talk to investors, it's just this funny mirage of like, you've got to make that emotional connection, or you've got to make them feel like, they are underwriting the deal properly. And for me, it really the focus should be on who is the person, and then also what are the actual agreements in place, because those are the things you can understand and control more so than, what are the deal mechanics and, what is money being spent on. So I just think that's really interesting. But I do think that's a really great place to wrap up, unless you've got anything you want to leave it off with. But we really appreciate you having on. I think this was an awesome episode, and I definitely enjoyed it. I think people are going to get a ton out of it. So really appreciate it.
John, did I pass the bar? Was I boring or not boring?
No, it was great. I really did. I'm actually going to fill out your fun stuff because I want to talk to you offline and about that. But no, I think everyone listening is going to hear it out, because you asked questions that most people don't to us to compare the two. And I think a lot of our listeners are into both of our spaces, and they can hear the mobile home guy asking the multifamily person why and why not, and vice versa. So it'll give them some insight. And Chris's points have been phenomenal as well. Like, you got to think about supply and demand. I mean, at the end of the day, that is investing. If you have something that people want, you win. If you have something that nobody wants, you lose.
For sure. Yeah. So Daniel, if people do want to learn about, the fund, you follow you, connect with you, all of that great stuff, where are the best places to do that?
Go to threepillarcommunities.com. 3 is spelled out THREE, pillarcommunities.com. Get on our mailing list. I am not doing a general solicitation for the fund. We've been talking about it, right? We've been talking about it kind of as peers, but I'm not out there soliciting or advertising for it. But if people want to get in touch, find me on the website, we can talk.
Perfect. Guys, go check out the website. If you saw me looking away earlier, I was. So good website, like it, definitely go hit it up. But thank you everybody for listening to this episode of the podcast. If you are not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send this episode to someone that would get a tremendous amount of value from it. Daniel, once again, thank you so much for coming on, man. This is awesome.
This was fun. Thanks, guys. Appreciate it.
Thank you.